Welcome to the CLS Market Review for the week of October 21st. I'm Scott Kuby. Congress and the Obama administration's production of A Nightmare on Pennsylvania Avenue finally ended last week with an agreement to reopen the closed portions of the government and increase the debt ceiling. The agreement avoided a follow-up production, Thursday the 17th, and the increased possibility of a default on government debt. Like many horror movies, the ending was predictable. It just took a while to get there. Much of the frustration by the public came from the House Republicans passing bill after bill with little apparent thought as to a potential compromise. After a couple weeks of a partial government shutdown and slight dislocations in the bond market, the House Republicans accepted a bill that could have been passed a month ago. Scary movies and scary politics also share a propensity for sequels. Friday the 13th, A Nightmare on Elm Street, and Halloween have produced over 30 combined movies. The approved bill only funds the government through January 15th and suspends the debt ceiling through February 7th. If no agreement is reached, then we get another nightmare. The only way to avoid a sequel is for the sides to reach some sort of compromise or keep passing short-term extensions. This unfortunate reality likens the current political situation to the zombie movies of old. You can run away from the issue, but every time you look over your shoulder, it's somehow caught up with you. How does the gory political theater we just witnessed impact investors and portfolios? And what may be a spoiler to the next movie, here are 4 key conclusions for investors to ponder. First, odds of a future shutdown and concerns over a debt default are lower. The Republicans fared very badly during the shutdown and are unlikely to repeat the process. Second, acrimonious politics makes compromise difficult. The hack-and-slash politics practiced by both sides make big agreements on budgets, entitlements, taxes, and immigration difficult. The likely outcome is a series of sequels that will thankfully lack the drama of recent weeks. Third, uncertainty will dampen investment. Businesses are less likely to make long-term capital commitments when faced with wide uncertainty regarding tax rates and regulation. Without increased investment, economic growth will continue to be slow. And finally, don't confuse nasty political rhetoric with risky markets. We often stress focusing on the long term in these updates. A bill to fund the government for just 3 months is unlikely to have lasting, long-term impact on markets. If it starts to bother you, change the channel. People are asking if this will ever end. It is a fair question. Austan Goolsbee, a former economic advisor to President Obama, offered an interesting observation at a recent speech in Chicago. He said the public needs to choose. Goolsbee says the public is sending too many contradictory messages. Don't raise taxes. Don't cut Medicare. Balance the budget. Until voters start engaging at a deeper level, John and Harry will take the place of Jason and Freddie as the leading men in the scariest show on television. Let me close by noting how pleasant it has been that my personal nightmare, Matt Harwell, has been contained to our monthly and quarterly market reviews.
Ahem.
That concludes our update for this, the 4th week of October. We hope to see you back next Tuesday. Have a great week.